Welcome back, everyone, to Broker's Playbook. I have the pleasure of introducing Denise and Nicolie of Laframboise Mortgage today on the show to discuss the current market conditions and the current environment that has a tremendous amount of consumers and clients stressed and anxious on how to renew their mortgages and what to make out of this very unprecedented, I suppose, market that we're navigating through. Stay tuned for current, insightful, and tactical insight that will help your business grow and help your clients live better lives. Denise and Nicolie, welcome to Broker's Playbook.
Thanks for having us.
It's my pleasure to have you. I'm very excited for today, and I'm excited to have you on. I've actually was speaking to my team the last few days on what route to take with you today. And we all kind of came to the conclusion that the market today is the most confused it's ever been in our experience.
I'd agree with that.
I've been in this going on 17 years. I want our audience of brokers and investors at this point to hear a little bit about your past, how long you've been in the business, the things you do for the industry. Let's just start there as to why should someone listen to Nicolie and Denise. And let's get into the Canadian market, which is a lot to unpack right now.
Oh, yeah.
Nicolie, why don't we start with you?
Sure. I've been in the mortgage industry for 7 years now. We started coming off different types of careers. I used to work in public relations, and I came into brokering from a perspective of wanting to make a difference, having different experiences with my home buying processes and mortgage acquiring processes, and felt that this was something that I could do. And through my career, we've developed a specialty in helping people who are self-employed and doing some of the more tricky things in the mortgage industry alongside Denise.
Denise?
Yeah, so I started 7 years ago as well. Nicolie and I took the mortgage agent course together. I came from healthcare, but I was a property investor. And
So that's what brought you into the industry, being an investor yourself.
It made it easier. I was always looking for answers that people didn't seem to have for me, and I knew that there were answers out there, and I wanted to provide a better quality of service to consumers in Canada.
Investor specifically is a big subject for me because I have this country's biggest investment-focused real estate team, meaning that the majority of our transactions, of course, we transact regular real estate, buying and selling homes, but I specifically am a commercial broker by trade, and about half my team focus on investment for the purpose of profiting, of investing their hard-earned money and growing it over time in the safest asset class possible. Mm-hmm. There's a couple things you said, specifically, Nicolie, that you specialize in business for self. Mm-hmm. Then you said investor. These are two of the biggest pain points in this country today, although the economy has changed so drastically, and specifically the interest rates and the cost of money, that everybody's feeling the hurt. Mm-hmm. Business for sale specifically, though, has been known to be the type of applicant that is almost punished for being an entrepreneur.
Absolutely.
The banks
and
favor,
definitely underserved in the industry.
And we're talking because I am in business for self. All of us are.
Of course.
When advising clients, there's nobody that knows, oh, you work for yourself. Okay. So right there, it starts with a negative connotation as to what their options are in the Canadian financial landscape.
At some places, right? Yeah. When they come to us, they're like, oh, you're incorporated and you have a great accountant who hides your money. You're my people. Yeah, I know how to help you because I do this for myself.
Denise, you've been in the business for 7 years. You see business for self, you see investors, you see all different sorts of applications. Starting with investors, what do you see an investor what is the biggest need and the biggest expectation an investor should have from their mortgage broker? And then, of course, how does the mortgage broker address that segment of the market?
Yeah. So when we're talking about investors now, we've always talked about cash flow, right? We're looking at properties that cash flow well. With all these increases, especially when a lot of investors are using a line of credit for a down payment, it's killing people. It's really hard to cash flow a property well. So we're looking at different solutions. Sometimes it's an interest-only payment. Sometimes it's looking at mortgages with no payments. It's looking at how we can maybe stretch out the amortization to be able to survive this time where rates are higher. Some people end up selling their properties. Maybe they're buying new ones that they can get tenants in for higher costs. And it's really just working with a broker or having the brokers themselves look at all the options, because there are clients that we run numbers for and say, you know what, if you sold and bought another property at a similar price that was vacant, rents have gone up a lot. It's really looking at the full picture and not just, hey, what can we renew you for, but what else is there out there that can help you?
Do you help your clients underwrite their own deals? Do you give them advice from a perspective of this is where you're performing today and your options today? Should this change here? Should you improve and re-rent, etc.? Or do you take them through the full spectrum of the investment when underwriting a deal?
Absolutely. Yeah. And we do that for our investors as well as the self-employed people, because not just the investors planning their portfolios, but if you're self-employed, maybe you need to figure out how much you need to T4 yourself next year out of your corp to qualify with an A lender. Or maybe you don't care about that. We can write off everything because we have enough expenses to qualify with a B lender. Or maybe you make cash income that has to go through a bank account so we can see it. It's really looking at all of the options and then what that individual can do to best help those options for themselves.
That's very interesting. Nicolee, I'll take this one to you.
Okay.
For business for self, Denise mentioned thinking forward, meaning that if you're thinking of buying an asset for investment or for yourself, you might need to change the way you T4 yourself.
Mm-hmm.
Let's unpack that, because there's so many negative connotations, specifically in the media the last quarter, where people are like, oh, I'm doing fake paperwork. Mortgage brokers don't have this, that, or the other.
Yeah.
The strategy that we're talking about is not creating fake paperwork. What is, so planning forward, instead of being in a specific tax bracket now, you do your accounting differently.
Yeah.
And then if you're going to be buying an asset that you know you need to qualify for,
Exactly.
you speak to someone like yourself to do what?
So, and it's interesting because there's a lot of crossover between investor clients and business for self clients. When you are business for self, you don't have the pension in place. So you're looking for different strategies to build your wealth. And when we have a client who's self-employed who comes to us and wants to make a purchase, whether it's the primary residence or looking to get a rental property or two, we look at their business financials. We do a full holistic look at what they're doing now, how their business is growing, and how much they're T4ing themselves. So to be clear, there is no creating documents here. There is no, falsifying anything. It's just different strategies
Of how to package it.
How to package it, because an accountant who is also specializing for business for self, their number one goal, and any accountant will tell you this, is to have their clients pay the least amount of taxes possible. That's their job. For us as mortgage professionals, our goal is to qualify you for as much mortgage financing as you can or you want. These goals are not necessarily aligned at all times.
They're actually kind of polar opposites.
They are a bit.
What is evading the other?
Exactly.
Yes.
So what we like to do is from the second we get a client, and we do get a lot of clients from accountants, which is a lovely symbiotic relationship, is figure out their goals for right now and into the future. So if they have been running a business that's profitable and they've only been T4ing themselves a small amount, that's fine. You're paying less tax, but you're going to qualify on the B side, which gets a bit of a bad rap, but honestly, B lending makes a lot of financial sense if you look at cash flow. If I have a client who's T4ing themselves the minimum to pay the taxes, but they're retaining earnings in the business and they have really robust business financials, there's a lot of options there.
So what I'm going to do, I'm just going to do a quick pause for everybody who does not understand T4 versus retained income for self-employed. When you have a corporation, if you keep the money inside if your business is busy, you do $300,000 in sales. You can pay yourself a salary of $50,000 a year to pay minimum tax at the highest rate. By keeping the money in your corporation, you're going to pay a maximum of 12, 14, 16, 18%, depending on what bracket you fall in. However, when you're applying for a personal mortgage, it's your personal income that matters. So these ladies are saying, when we're preparing for this, maybe we need to pay a little bit more tax and pay ourselves more here in order to qualify.
Exactly.
I hope that helps. Please,
I
please
feel
continue.
And that's the standard, right? But there's exceptions to that rule as well. There's special programs. We have programs with A lenders where we can add retained earnings back into your income to use it
where
for
the bank will
stress
allow
test.
that.
Yeah.
Because they know what's happening.
Yeah. And when I think about talking to self-employed people, we're really looking at giving them options. So when I looked at buying my last rental property, I could T4 myself differently and pay an extra 75 grand in taxes for 2 years in a row to qualify for it. Or I could buy it with a B lender on that day and it would cost me an extra $150 a month more.
So that's why we need to look holistically.
Isn't that interesting? Because many people will say, I'd rather get an A lender and pay my tax here because they simply don't know the cost difference, which is so minimal potentially.
But working with their accountant, or if we look at global savings and we're factoring in what you're paying tax-wise, it might be cheaper to not try and go to an A lender. It might save you more money. It might get you properties faster. Nicolai and I bought a property with a private lender, which people think, oh my gosh, a private lender, that's terrible. But it allowed us to get a cottage before we qualify for it, Airbnb it, with a lender who does not care, and we have no payments. So we're able to pay off the line of credit we use for a down payment faster.
Well, I think it's very important for people. Well, I think it's very important for people to remember one thing. A mortgage is nothing more than a tool to acquire assets that work for you, that the money that you put to work actually performs at a better rate than anywhere else using a safe and stable asset class.
And it is a change of mentality for that. You know, the clients that you're talking to with your business, those investor clients, and as well, people who are self-employed, they understand that more, or it's our job as the mortgage brokers, and something that we do is having those conversations around that piece. When somebody's a first-time home buyer or maybe purchasing a move-up property, rate is so the sticking point for them, and like best rate.
And
it's not. And that's kind of, especially in today's really more difficult market, it's not the main topic of conversation, and it shouldn't be. I know that the media and all these rate increases is making it still at the forefront in a really negative way, but that's not the number one thing that you should be looking at, especially in investing or as a self-employed person.
Well, I do believe I had a guest here, Don Scott. He's the founder of Frank Mortgage. Phenomenal human being, very intelligent man. And he brought the point that what he witnessed during the pandemic's cheap money barrage, which was nothing more than a stimulus to the economy, which many of us understand, many of us don't. But at the end of the day, what he witnessed is the absolute recklessness of media and the major banks of pushing variable mortgages, a non-risk adverse mortgage, to everyone blanketed. Go for the cheapest rate. It was the rate competition. We had seen HSBC at 0.99 at some point. People were blinded to the rest of the terms. If you asked anybody, what is a mortgage? That's my interest rate.
Yeah, and we see a lot of people now coming to us saying,
But
I didn't understand it was a variable rate
but
mortgage.
Nobody explained it. That's what Don brought to the table. He's saying it was reckless because the banks themselves have a room where they judge everything on risk. They were not risk adverse. They were risk adverse, by taking all the actions to fix their portfolios, but they were shoving variable mortgages down everybody's throat recklessly. And I do agree with that comment.
I do. I also think we had consumers at that point, being in bidding wars against 25 people and saying, no, I need the maximum. Well, the only way we can qualify you to the maximum is to take a variable. At the time, the fixed rates being higher plus the 2%, they didn't qualify for what they wanted to buy.
So we saw variables becoming the tool used to acquire properties in competition in many different circumstances.
Yep.
Those people today who are now crying foul, I didn't understand, I didn't get the impact that it could possibly have. Nobody saw this coming. How do we help a consumer today? What options does a consumer have, or a mortgage advisor, to give advice to their client? What options are available in a market like this today?
So I would say the key one that we're seeing a lot of and that we're doing a lot for our clients is asking for an amortization increase. Your lender might tell you that they can't do it, but if you push them, they often can. That's a vehicle to keep that low interest rate you have and push out the cash flow to make it better for you with no extra cost to the client. And that's something they're not being offered just by asking. It's something you have to push for. So that's one option, looking at locking in scenarios. Depending on the client, sometimes we can refinance them into a different product that's going to cash flow better. Sometimes we can't, right? If they don't have the loan to value, sometimes they don't have that option.
So just taking the action of asking for better terms for somebody who's suffering can potentially give that result. Is it well known in the industry that you can do that, or is that something that more experienced brokers know about because they'll take the time to do that?
I would say people unfortunately, inherently, people look at the options to present that are going to pay them, right? They don't always look at the options that aren't going to. But if you're serving a client holistically, that's a client for life that will come back to you, even if it's not paying you now.
Playing the long game.
Exactly. Like, we're having so many phone calls from our clients, but also from our new clients who didn't perhaps work with us the last time around, who are in really hard financial situations. I've had multiple people saying, I need to get a second job to afford this. I don't know what to do. I think I'm going to lose my house. And that, again, the narrative in the media and all the doom and gloom, I can understand people feeling that anxious and unsure. But to Denise's point, we always look at the options available to them for the least amount of expense, the least amount of disruption to continue to be in their home. So if it is telling clients, hey, you know what, your best option here is to request that extended amortization, or to ask to be locked in to a certain rate, provided that makes sense for them financially, that's what we're going to tell them to do. We will help them find the contact that they need to talk to, even if for us, it's not a deal that's getting us paid, because it is the long game. They're going to remember us.
Correct. The client always does. I know that to be true. In my 17 years, we never focused on the short game, and it's come back to us tenfold. Let me just put it there, because it comes back with referrals on top of it.
Absolutely.
So I'm not worried about that. And that's great advice to anyone in the business. Understand that taking the client's interest is in your best interest at all times. Yeah. So that's a good one.
But further to that, Simeon, like looking at other options, if there are other options in the market, having those conversations about B lending. So with B lenders, they are a lot more flexible on different ratios. They can extend amortizations for longer. And sometimes it is taking a higher rate than what you're locked into, or what you felt you were locked into with these variable rate mortgages, and extending the amortization back out. Because then we're looking at your monthly cash flow. We can look at combining some other really high interest debts and different payments.
And bringing the entire situation to a
bring
better
it
place.
all together. And while the rate can look a bit scary, especially if you've become complacent over the last few years with this, what we called mortgage Christmas.
Yep.
It's definitely a way to look at helping your client move forward. But only if the numbers make sense. We would not do that for someone if it didn't make 100% sense, and we lay that out for our clients.
And that does make a lot of sense to me. I think you give great advice, and this is exactly, well, this is why you're here, is because we believe at Brokers Playbook that you are doing things differently. And this is the type of insight exactly that I wanted our audience to hear of both mortgage brokers, real estate brokers, and of course the investors themselves. There are a few other audiences that I want you to give advice to. If there is a young couple looking to make their first move into real estate, Susie and her partner both work regular jobs, not self-employed, and they're looking to buy their first home. Average price for a condo in the GTA, let's call it $700,000, whatever the case may be, $650,000, $850,000, it doesn't matter. They need to qualify for a mortgage. They are deathly afraid that they're going to get into a home now and the prices are going to drop, or the interest rates are going to go up further. The interest rates are going to come down and they should have just waited. What is your advice to the new home buyer today on how to structure, how to decipher, are interest rates abnormally high right now, first and foremost? Can they expect this to be the situation for a few years? How do you go around those big hot topic items?
Yeah, so I would say like they're definitely the highest I've seen them in my home ownership career.
They're not the highest I've seen them in mine.
But
You're a little older than us.
A little bit older.
yeah, my first mortgage was 5.44%, so 2006. But I think when we're looking at first-time home buyers, we have to look at the big picture. For some of our first-time home buyers, it's maybe getting more gifted down payment in order to keep that mortgage amount low so the cash flow is okay for them. Even though maybe they qualify for more at a variable rate mortgage, they might not be variable rate people. They might need a fixed payment for the next 2 or 3 years so they can budget properly to know what to expect. And when I say a gifted down payment, like maybe that's a reverse mortgage from their parents' home, so there's no payments on that. Maybe it's putting a line of credit on their parents' home that they're able to make the payments on, but that's keeping cash flow better. I mean, we need to look at the whole picture. The reality is when we look at helping these people, if they don't get into a home, rent is higher. And that's also concerning, right? When I think about my own kids, how are they ever going to buy a condo when they're ready to do so and the average price of a condo is $2 million? Like, I want them in properties earlier, or I want to buy investment properties that they can live in. But for these first-time buyers, maybe you're not buying your dream property. Maybe you're buying a duplex with some rental income to help offset your costs.
Do you believe in home ownership?
Absolutely.
So your advice to a young couple looking to buy their first home, because that's a big demographic right now.
Mm-hmm.
Yep.
And there's a lot of young people coming into the country as well via the immigration targets that are in place. Whether there's students that are within 3 years are going to be labor force, because people talk about students like they're students for life. No, it's a very, very limited time. 1 year, 2 years, 4 years max.
Yeah.
But then they go into the labor force. They go into the consumer mechanism, the entire thing. They need a home, cars, all the things. Young students turn into a couple, need a home. I ask again, is it more important for them to lower the expectation of what that first home looks like, of how big that home is,
Yes.
to get into the ladder? Is that your advice?
Absolutely. Right. Like, my first home was not my dream home. It was this terrible bungalow that we had to rent the basement or we were going to like go bankrupt. It was not where we were ever going to stay or raise children, but it got us into the market. And I had friends who bought their dream homes at the same time. And that small little house that we were able to refinance and then keep as a rental and buy the next one was the mechanism that helped us build our net worth faster.
That's incredible. Let's go to another demographic. that is also a hot button topic, because you mentioned reverse mortgages just a second ago. People who have smaller mortgages, but they also have fixed income. Let's speak to our 60 plus, because many of them are retired and or they're on investment yields, meaning that they're not working because they put X amount of dollars into any investment. They're living off that dividend. For anybody on fixed income that has been terrorized over the last year and a half, because the only enemy of fixed income is a variable expense.
Absolutely.
With that being said, what is your advice? What options? Let's go with you, Nicolee, on this one.
Sure.
What options does a senior or fixed income consumer have in a marketplace that's seen 14 increases in a year and a half?
Absolutely. And I think it is a stressful time for everyone in this market, and much more so when you have a fixed income. You're not looking at increasing your earning potential in the next few years.
Or you can't.
Or you can't. Like, this is where you are, and this is the reality you have to live in. And then to feel like, oh my goodness, does this mean I can't continue to live in my home that I've been in for the last 40 years that I built my life in? The answer is no, you can stay in your home. And there are a lot of, there's a few vehicles in the Canadian market that enable that to happen. The reverse mortgages are one that really does work very well for seniors. And again, in a Canadian market, they're very conservative on how much loan to value based on the property's value at that time that
That's
they're able to.
typically 50%?
40 is a few of them. And interestingly, we have a lender that's recently come back into the market that is actually open to people who aren't seniors as well for a similar type product. But it's something that allows people to stay in their homes for longer. And the way that we operate as mortgage professionals, we're very concerned in making sure our clients' best interests are served now and in the future. And all of these products that are in the Canadian market are things that we're comfortable putting our clients in. We have a number of clients that we've been working with over the last few months who are exactly in that situation, that we find reverse mortgages so they can access the equity in their home and that they don't have any payments for it. And in fact, they can set it up so that they have a monthly draw from this mortgage that's set up.
Actually generating income.
Exactly.
From their equity. Of course,
equity.
It's not income. It is accessing equity.
It's accessing equity that you can then draw down on a monthly basis.
Right.
So if you're on this fixed income,
I just want to label it right because it's not
actually income. It's accessing the equity. And so people who are on a fixed income, we can supplement their income so that they're not feeling that pinch. Because everything is more expensive right now. And the exit strategy then, and with different products like this, whether it's a private mortgage or a reverse mortgage, there does need to be that thought of an exit strategy as what they're going to be doing. All of the lenders model that out for clients to show how the equity in the home is growing at a certain rate versus how much the mortgage is going to cost. Because if you're making no payments, you do have to make those payments at some point.
Of course.
And it's not month to month, but it's on exit. So these...
And what is the typical exit? Is it upon the consumer passing away and the estate handling it? Is it on a sale date? Is it a combination of...
Those two are definitely the ones that we see
the most.
The most. It's very unlikely that someone would go from a reverse mortgage back into a traditional mortgage, but it does happen. But generally, it is on sale. So if someone can no longer live in the home for whatever reason, or they choose to downsize at that point in time, it really allows that breathing room for clients to do things on their timeline rather than feeling the stress and the pinch and the negativity of right now. It just kind of gives them ownership back to their decisions.
So I absolutely love that, because I think you did a great job explaining this option for all that senior demographic or the fixed income demographic that does enjoy home ownership, of course. But Denise had mentioned while looking at some creative strategies for new homeowners, you had mentioned, well, maybe you can access your family's wealth in ways that most people don't think of. So if my parents, may they rest in peace, excuse me, if my parents did not have the income to help me because they were living off their savings, but the home was paid off, and they could borrow using a reverse mortgage to help me, this enables my homeownership journey while it doesn't affect their livelihood and their path.
Yeah, there was a study that came out in January that said 64% of new homeowners are getting help from parents, help from family.
And that we see anecdotally in our practice every day.
Everybody thinks cosigner, but your parents may not have the income to cosign, or it might not be reasonable for them to cosign, or they might want to buy a cottage or help your other sibling, and they can't do that if they cosign, right? So looking at other options, it's basically giving an inheritance early.
I just found that so creative because I've personally never thought of that. And what a tremendous option, because you're actually taking advantage of exactly that. It's an early inheritance, early access at a time that you actually need it, not when I'm 50 and I don't need it.
Exactly.
Well, and bless them. Like my parents are those people, house paid off, and they're like, someday when we pass away, you guys are going to get some money. We don't need it later. Right? Like we needed to buy real estate now, right? And if there was a vehicle for them to do that isn't going to cost them any month, or they don't have to sell their house, it doesn't change their cash flow. And that could be a reverse mortgage, depending on how old they are or what the value of the home is. Maybe it's a line of credit, that the payments for the line of credit just go on the line of credit and you make no payments. We can use that as a reverse mortgage as well.
It's absolutely brilliant. Nicolai, what were you saying?
I was going to say as well, sometimes your parents, they seem very wealthy, and they're those self-employed people, they're those investors, and their T4 income doesn't bring anything to the table. And
it reflects nothing of their reality.
And their investment manager is like, no, you can't touch any of that. That's for like your ongoing living. And so they've got this situation where they're like, well, I'm not pulling my investments because those are making me good money. That's what I'm living on. Like it gets around a lot of these difficult conversations, but these are not conversations that people necessarily know how to have. And for us, like when we're working with first-time home buyers, we often will kind of put these suggestions forward, and there's a lot of those resistance. Oh, well, my parents don't have this, they don't have income, their house is paid off, but they don't have money in the bank to be able to give me anything. And that is the generation. The goal always was pay off your mortgage as fast as possible. You don't want the bank to own your house, you want to own your house. And so much of that generation has so admirably met that goal. But now they're in that situation where the transfer of wealth is not going to happen until much further
we're
down.
Already going through the biggest wealth transference this globe has ever seen. It's trillions globally, and we're seeing a very creative way of accessing that transference earlier for many who need it. I love that. I want to touch on one last subject, ladies, and I'm going to bring this to a close. First and foremost, thanks for all your insight thus far. I think it's very useful and tactical to be deployed in the field today, so I thank you for that. But both of you at different times said the word a holistic approach. And I think there's many ways to say that. It's called a client intake. For those who want to take a more business term at it, it's taking the time to know your client, to those who don't want to use a term. But I think what you do differently from a fundamental, from the absolute ground up, is that you take the time to understand the client, all the circumstances, the dynamics that manage. In order to give somebody advice about accessing their parents' home, you have to ask, are your parents around? Do they own a home? What does that do for you? What options does that give you?
Yeah.
I want you to give advice specifically, and both of you will have your take on it. Denise, let's start with you. What is your advice to your brothers and sisters in the business, giving advice to client every day?
Let's think of the average client who calls you right now. Most of the people we're hearing from on a regular basis daily are people who had a 2% interest rate and they've got their renewal paperwork and it starts with a 6 and they're panicked and they say, I can't afford this payment on this piece of paper. How can you help? What interest rate do you have? Here's the interest rate my bank offered me. And you have to ask more questions. You can't just say, here's the interest rate. Do you have a line of credit? Do you have a car payment? Do you have other debt that we need to roll in here? Is the amortization set at 12 years? And if we set it at 30, you can afford this? Are you only looking at a 5-year fixed rate because that's the lowest rate? And maybe we only need a 2 or a 3 year to get us to where economists expect rates to be lower. We need to ask more questions every single time we're trying to help somebody, because you will identify their pain points and opportunities where you can provide them more options to be able to help them.
That's a tremendous response. So that intake meeting, that getting to know your client has to be wholesome every time. And if you don't know what questions to ask, maybe you should be seeking mentorship within the industry, because your job right now is not one that I envy. Like, I'm telling you that from the bottom of my heart. You are seeing the front lines of people's hurt. We see it close second. About 8 months or 12 months after enduring the trial of such an increase, we see the client come in and saying, what are my options? I cannot take this anymore. And now we have to restructure them as real estate brokers and agents.
Yeah, I mean, this is the first time in the market I've ever seen people making their mortgage payments with credit cards.
I have literally taken 2 interviews in the last 2 days, one with Bloomberg, one with Toronto Star, speaking about the increase in inventory that we're seeing, and is that investor driven? And I'm not going to go down that whole path. I want to get Nicolee's take on, and I'll touch up on it at the end. But Nicolee, what is your advice specifically to your brothers and sisters in the business, further maybe to her insight?
Yeah, and so it's that KYC, the know your client, and through knowing them, knowing their pain points, asking all the questions, ask the tough questions. Ask, what is your tipping point? Like, how much can you afford a month to continue to do this and, feed yourself and your kids and do all of those pieces? Ask the hard questions, and then never delay having hard conversations. Because at the end of the day, you are an expert source for information. The information is what it is.
Sugarcoating is not going to help anyone.
It's not going to help anyone. Like, don't be mean. Like, there's enough meanness out in the world right now. But as long as you are being forthright and honest and letting them know their options, they might not like any of them. But presenting options and always presenting more than one if you can, even if one of them is, you need to sell your house. You need to do those things because it's not going to get better by delaying. Somebody in a situation where they feel that they're in a variable rate mortgage and they're being buried in consumer debt, you not giving them the answer is not going to help them. Give them an answer. Like, follow up with your client and make sure you are giving them the service that they deserve, even if it's not going to get you paid, so that they can continue to move on with their life. It is our job to try and reduce the stress that everyone's feeling, offer that expert advice, and be that person, that advisor for them to help them to move forward. So that's...
Brokers Playbook Nation, I want to thank you for listening to another episode where I felt both Denise and Nicolee brought tremendous amount of insight to our industry people, giving advice to their clients every day, and to any business for self, any investors, any first-time homeowners, downsizers. You have options. And the first option anybody should look at is working with someone that doesn't have the bias or representation of any single lender. When we're talking about mortgages, working with a broker who represents all lenders is typically and customary going to give you much better service than going to any one institution and only exploring the options available to them. Until next time, thank you for joining us. We'll see you soon on Brokers Playbook. Thank you, ladies.